lagging industries. That's another thing. When the market's falling like a stone and everybody says jump into healthcare because that's a defensive move like we saw, why would one jump into anything in the market environment we're in right now? I think that I really feel sorry for people who don't have charts to look at, because to me, buying something right now is like, if you don't have a chart to look at when you're buying it, it's like driving down the street with a wet blanket, a gray blanket on your windshield. It's like you have no clue where you're going. Thank goodness we know how to read charts in the good times and the not so good times. This is a daily chart of the ProShares ROM, R-O-M. This is the 2 times leveraged technology fund. The biggest stocks in this are Microsoft, Cisco, Intel, and then we go down to Google, HP, Hewlett-Packard, and all that group. Now, you can sell short, just sell short, these 2 times leverage funds. They're not inverse. These are not inverses. You can tell by looking, that's gone down. And you can do very well doing it. When we're in a bear market, target, that's what I didn't mean to say, target lagging, when we're in a bear market, target lagging sectors to go short. And we all know that in times of great dis-ease and recessionary times, technology is going to fall like a stone, because companies aren't saying, oh, I know, let's go buy more computers. They're saying, let's add new systems. They're not saying that so much. We're all kind of locking down. So one could sell short technology very, very easily in this particular instance. In this case, you would be selling short the 2 times leverage. Now, you've got to be careful. There's throwback rallies involved in these. I put a little bottoming triangle here. Then the ROM popped back up in August. We knew the news was getting worse on the environment. Then it broke that. See the sideways consolidation? You don't want to sell short before it gets there. There's too many buyers lurking. Then it made the fall. Now, can you see? Can all of you see this little throwback rally here? It was a one-day. You see that red candle? That was a little throwback rally. It was a quick one. It would have stopped some people out. And this is 2 times leverage, so it's a real, it moves very fast. There's an actual, that day was up on every single stock. It moved up and then fell like a stone. That was, again, the Lehman Treasury day that got all mixed up. It's like, yay, oh. That we've been experiencing lately. You can do that, though, and these are very good indicators. As well, you might want to note here that you had a negative divergence on the MACD. Everybody knows what a negative divergence is, or a positive divergence? Okay. When you have an indicator like the moving average, divergence, convergence oscillator, just the MACD, maybe I can find a better chart. Okay. Huh? When the indicator, when you have a divergence, it means price is going one way, like up. The indicator is going down at the same time. It means the indicator is not at all impressed with what price is doing. And we'll find one. I can kind of see one here. I don't know if, yeah, I can see it here. It always happens. Right here. Look where in May, look at this big volume spike just before it in May. You see the MACD is kind of moving higher here? Line it up right up here. Okay, now can you see? And so the MACD is going, all right, everything's good here. I'm liking this ROM. It's going higher, 2 times better than technology. Life is good. But you say as a trader, yeah, but the ROM is hitting its 200-day moving average, which is sloping down overhead, and that's a negative. So you're not buying yet, you're watching it. And then you say, you watch it come back up and make a fresh high, or try to right here, bumps its head on the 200-day moving average. Immediately you look down and you see that the MACD is falling when price actually moved up and made almost the same high. And you say, what's up with that? Oh my gosh, the MACD is not at all impressed with what the ROM is making a fresh high, almost an equal high to the last one, but the MACD is moving down saying, I'm not impressed at all. And the operative theory here is that price will follow eventually the line of the indicator. And the MACD is pretty reliable. There are other much fancier indicators out there and momentum indicators, but the longer I trade, the more stuff I take off my screen. It seems to be a progression that all traders go through. Did you know that? First you start out, and then some of you know who've been through it. First you start out, and you're a rocket scientist. You can be a trader, and you can make a boatload of money, and you just know it. And you can beat the system because you've learned how, and you've studied hard, and we all go through it. So then we get into it, and the very worst thing that can happen to you is that you make money on your first trades. It's the very worst thing that can happen. I made a fortune on my first trades. And I called all my friends from the stockbrokers who told me not to do it, and I said, you guys are nuts. This is a walk in the park. That's the last thing I remember for a year and a half. Oh, it was ugly. Ooh, it was so ugly. And then you come out of that, and if you live through all that and you still say, all right, I'm going to crawl through this, make some money back, then the search begins for, you get through the fear thing, which is fear-based trading. You get through that. And then you say, all right, now I'm going to go find the Holy Grail. I can do this. So you go out looking, and I'm not saying you guys, but a lot of people do this, go out and look for the Holy Grail. And they go out looking for the one indicator that will save their lives. And we all have our favorites. Certainly I have mine. And then you put everything on your charts. You put a million indicators, and you study them when everybody else is out at the beach. And you talk to other traders, and that's all you can talk about. And I was the same way. And then you get through all that thing, and finally you start looking at them long enough, and you say prices, and as Richard Arms said, price and volume is really it. Then you start ripping everything off your charts because you get to where your eye can see and you can internalize market movements, and you get to know what price does kind of and when it does in relation to volume, and a couple of the 20-day moving average will work. Heck, that's all I really need. And volume, got to have volume, that's key. And you start ripping everything off your charts. So that's about what I've done now, is gotten everything off. The price will definitely tell you, and as he says, that's the most important thing. Nothing else really